Did former Federal Reserve Chairman Ben Bernanke deserve the 2022 Nobel Prize in Economics? Join Richard Ebeling and me in this week's Libertarian Angle as we examine that question. Hi, I'm Jacob Hornberger, president of the Future of Freedom Foundation. This is this week's Libertarian Angle, the show that brings you all the principled case for libertarianism, the free market philosophy, private property order. I'm joined, as I am most weeks, by my co-host Richard Ebeling, professor of economics at the Citadel. Richard, good to see you again.
Great to see you and to be with our viewers and listeners.
Yeah, thanks for tuning in. If you're new to FFF, you can come to FFF.org for 3 decades worth of principled articles and commentaries and videos and the like on libertarianism. Subscribe for free to our FFF Daily, which we have long strived to make the best daily libertarian commentary page on the internet. Our monthly journal, Future of Freedom, this YouTube channel, Twitter, and of course, consider becoming a donor to FFF. So, Richard, one of the nation's premier central planners in the field of monetary affairs, Ben Bernanke, was awarded the Nobel Prize. Imagine that. A great central planner being awarded the Nobel Prize. No real surprise there. But I thought we ought to address the issue, and since of course, you have much more expertise than I do in this area. You're the author of FFF's great book, Monetary Central Planning in the State. I'm going to defer to you for your judgment, but I will just say that some of the things that I remember about Bernanke, that he was Fed chairman during the 2008 bust cycle that comes with monetary central planning, the boom bust cycle that the Austrian school has long pointed out. And he was the guy that really, it seems to me, set the stage for this massive inflation or price inflation, massive rise in prices that we've seen lately with his so-called quantitative easing. I mean,
right.
Lowered interest rates during his entire term, almost down to zero, and just tremendously expanded the money supply. And we didn't really see the effects of that until COVID came along, and then they really injected the money supply even more during that period of time. But it seems to me that Bernanke set the stage for this massive price increase back in 2008. The other thing that I remember him doing was that he was an active participant, as I recall, and you can correct me if I'm wrong, in the bailout of financial firms that in the 2008 crash. There were firms that were going to go under, big Wall Street firms, and he used federal taxpayer money to bail these people out, which of course is just classic socialism in a market economy, or even in an interventionist economy like we live in. If you make the wrong calls, you go under, and there's always firms there ready to take your place. But that's not what he did. He said, well, we need to take care of these big boys up here. And he just took federal money and said, here, you don't need to worry about going out of business. You don't need to worry about losing massive amounts of money because we're going to use taxpayer money to bail you out. So with that, let me turn it over to you and give us your insights on this Nobel Prize winning economist.
Well, it's an interesting award. He actually is a co-recipient of it. 2 other economists receive it for their supposed insights on bank failures. Basically, their insight is runs on banks can deplete the resources of banks. Well, nobody ever thought of that before, but of course, I'm being sarcastic here. They did the other 2 recipients did these analyses that banks can suffer from bank runs, and that can sort of snowball and exacerbate, or in fact, basically cause what might have been a panic into a disaster. But what I wanted to focus on was Bernanke. Bernanke was very well known before he joined the Federal Reserve, was extremely well known as a monetary theorist teaching at Princeton University from some papers he had written in the 1980s. He basically reached the conclusion that Milton Friedman and Anna Schwartz had been correct in their monetary history of the United States, which had itself been published in 1963, that that part of the severity of the Great Depression of the early 1930s was the degree to which the banking system had collapsed, and that the banking system had snowball collapsed, Friedman and Schwartz argued, because the Federal Reserve had not maintained sufficient liquidity in the banking system to counteract the massive withdrawals from investment that's turned sour and withdrawals by depositors. Bernanke's lesson then was that the Great Depression could have been greatly reduced in its severity and its length if the central bank, the Federal Reserve, had supplied enough financial support to the banks that they could meet all of their obligations, both in deposit withdrawals and shortfalls in their balance sheet due to investments that started to go sour. The importance idea being is that the banks are important. They're a central feature of the financial and economic system as a whole. And if they go bad, the economy goes bad. That's the conclusion he drew. So fast forward to 2002, he joined the Federal Reserve Board as its vice chairman under then Chairman Alan Greenspan. And he and Alan Greenspan, he was greatly influencing Greenspan, this is that the problem from around 2003 seemed to be not inflation, but deflation. Oh no, the prices are starting to fall. Now, of course, most of this had to do nothing with a recession, but productivity increases in the U.S. economy that were making more goods available at lower costs. So prices of many goods seemed to be possibly declining. So, oh no, we have to counteract deflation. So to make a long story short, between 2003 and 2008, first as the Fed vice chairman, and then after 2006, with Greenspan's ending of his term, becoming the new chairman of the Federal Reserve, Bernanke proceeded to follow a policy of flooding the financial markets with, quote, liquidity, unquote. So much so that between 2003 and 2008, the money supply in the banking system increased by about 50% in a 5-year period. Interest rates in inflation-adjusted terms were in the negative range for most of that 5-year period. And as a consequence, money was free. You borrowed at a nominal rate of maybe 1.5%, 2%. But the fact is that when you adjusted for the low inflation at that time, price inflation, there were negative rates. So you were borrowing money for free. You borrow $100 today, and in real buying power, you pay back $96, at the end of the loan. So money was absolutely free. On top of that, federal agencies such as Fannie Mae and Freddie Mac were guaranteeing home mortgages, or either just buying them directly if the lender was nervous, even if the loan seemed secure. So that you basically created this huge financial bubble, this housing bubble, both of which came crashing down in 2008 and 2009. And what was Bernanke's response to that? Oh, I'm going to now put in practice the lessons I've learned by being an economic historian and theorist. We need to flood the markets with liquidity again. So beginning in 2009 and 10, his answer to the very bubbles that he created and then burst was to then flood the market with even more money. So that between 2009 and 2010, until let's say 2020, and he was Fed chairman until 2016, 2014. He basically followed this policy of quantitative easing. And what was this? Continue to buy large amounts of government securities. Now, that because of the government deficits, continue to now add to the Fed's portfolio by investing in mortgage-backed securities. So a lot of these loans after the crash were bad, and the Fed were buying them up. So a huge part of the Fed portfolio is made up by these mortgage-backed securities of uncertain quality or reliability. And since the Fed is never audited, we have no idea of the financial status that these loans have had in the Fed's portfolio ever since then. And then they started buying up a variety of other assets, all of which meant that they're buying up government securities because of the budget deficits. They're buying up mortgages, and they're buying up a variety of other private sector assets and creating all this money, trillions of dollars, trillions of dollars. Now, I have to confess that when the Fed started doing this in 2009 and 2010, I, like a number of other people on sort of our side of thinking, expected to see massive price inflation. How could you raise trillions of dollars without, after a certain period of time, massive price inflation, all the dollars percolating in the economy, reaching people's hands, people trying to buy things. And we did not see that because, you see, Ben Bernanke added a new trick to the Fed's policy toolkit. And what was that? Paying banks not to lend money. See, they got nervous. Even very soon after they started doing this, they got very nervous. Oh, we're creating all this money. The banks will lend it. Prices will rise. Oh, so we're going to pay banks not to lend the money we've created. So all this money is pushing interest rates nominally very low. So let's suppose the nominal rate of interest is like 1.5%. Well, that's low, but a bank could still make money even at that. Because when you're talking about hundreds of millions, billions of dollars, even 1 or 1.5% is big bucks. But instead, now the Fed says, okay, rather than lend a loan, extend a loan to Jacob Hornberger to maybe buy a house or undertake an investment for 1%, we, the Fed, will pay you 1% plus some fraction. And that fraction, while seeming small, in fact, is basically being paid to bear no risk. You're being paid to do nothing with that money. And in fact, approximately half of the money that they created, over half actually at certain points, was basically being held as unlent, or what economists call excess reserves in the system. But that meant that all of this money was there at any time to spill over into the real economy. Then what happened? Bernanke has left, but his legacy continues with the quantitative easing. And then beginning in 2000, with the coming of the coronavirus and the lockdowns, the shutdowns, don't go shopping, don't leave your house, don't buy anything other than what we declare to be essentials, the economy imploded. And now the heir, after Janet Yellen had been Fed chairman after Ben Bernanke, now Jay Powell is the Fed chairman, and he floods the market even more. So that between 2020 and 2022, that is during these last 2 years, the money supply in that 2-year period increased by 50%. 50%. So as a consequence of this, finally, all of this money being out in the economy and various other supply side problems has brought about this explosion of delayed price inflation. So much so that in July and August, as measured by the Consumer Price Index, which is released every month by the Bureau of Labor Statistics, price inflation is now rising at 8.5% at an annualized rate. And I've just mentioned that this is the worst price inflation that at least a couple of generations of Americans have ever experienced, because we haven't seen this since the late 60s, 70s, beginning of the 80s, when at some points in the late 1970s, price inflation was rising at an annualized rate of almost 15%, which was the highest since the American Civil War over a century earlier. And so now what is the response? Well, by Jay Powell, is that, the answer is to raise interest rates and cool the economy, which of course sets in motion the very recession that an inflation inevitably brings about anyway. But to get back to Bernanke, basically Ben Bernanke's mindset is that financial markets are inherently susceptible to unstable uncertainty, panics, withdrawals, fearfulness of maintaining loans, and that there has to be an outside government agency, a central bank, that is always there to micromanage the macroeconomy, putting money in here, assuring sufficient capital reserves, pushing down interest rates to keep spending flowing, and that we just turn the dials and we push the buttons, and in sufficient ability of this, we can maintain the economy on an even keel. The perversity of this award, in my opinion, is that he has been recognized for a policy lesson that he said he had learned from studying the Great Depression of the early 1930s, which when implemented has created all of this monetary roller coaster disaster of the last 20 years. He orchestrated the bubble of 03-08. He oversaw the financial crisis of 08, 09, and 2010. And through introducing quantitative easing, he introduced and those who succeeded him continued this quantitative easing that has created this ocean of money, finally, which is flooding the markets and creating price inflation, and now the other central planning response of pulling in it and bringing the economy down through a recession. So what he's being awarded for are the policy proposals that have brought disaster for 2 decades. And that obviously makes him deserving of the award.
All right, let me ask you a couple questions about your analysis, which is excellent. With respect to the quantitative easing that he orchestrated, you said that he was expanding the money supply with these injections into the banks, the banking system. But then he then nullified that to a large extent by paying the banks more than what they would be earning if they loan the money out.
Yes.
Now, then you say that money is in the system. Does this mean that he stopped paying this money to the banks?
No, they still do.
They still pay them. So there's still it would seem to be a nullifying effect there then on that quantitative easing
in other words,
money.
It would be, the price inflation would be worse now if they weren't doing that.
I see.
Because the markets would have been flooded over these years with even more money.
So if they stopped paying that money to the banks, then we would see the effects of that massive quantitative easing then.
What we would see in principle is that once the Fed stopped paying that extra interest premium, not to lend to Jacob Hornberger, but now to find if they deemed you credit worthy to extend a loan to you, the money would come into the market through Hornberger's borrowing and Joe Blow's borrowing. It wouldn't all explode in one overnight, but as this money started percolating through the economy, as banks were extending loans and reducing their excess reserves, that would just be adding, fuel to the fire in terms of price inflation.
And so what effect does his raising of interest rates, which according to the mainstream media has been pretty dramatic, what effect does that have on this quantitative easing money?
Well, it's a matter of then seeing to the extent to which the Federal Reserve continues to pay a premium that still acts as a negative on the banks extending the loans.
All right. Now, let me ask you.
I should mention one other thing, if I can, Jacob, because I think it needs to be pointed out. In this entire process, whether it be Ben Bernanke or Janet Yellen or Jay Powell or those who preceded them, the presumption is that a policy tool for the Federal Reserve to introduce is interest rate manipulation. Now, interest rates are a market price, like the price of hats and shoes and bananas and so on. The rate of interest is supposed to bring into coordinated patterned equilibrium the willingness of people to save a portion of their income and extend it to those who would like to undertake loans for borrowing purposes, expanding a business, starting a business, a home loan, whatever. But interest rates are supposed to be the coordinating price in financial markets that brings borrowers and lenders into coordinated balance. Not too high, not too low, but a balancing, like the price of shoes, that's supply and demand for shoes and so on. But rather than allowing interest rates to play this coordinating role which itself would prevent the likelihood of these fluctuations, the Federal Reserve uses it as a policy tool. And what do? They invariably push interest rates down below where the market would have set it for some period of time. And as a consequence, they mismatch the demand to borrow with the amount of savings in the economy. And they fill the demand for borrow in excess of available savings with what? Printing money. So as a consequence, for the last 10 years, and I'm just going to say since the crisis of 08, 09, but that would be preceding that as well, but just looking over the last 10 years or so, we have had financial markets without a functioning price system. Because how do we know how much savings is really in the economy? How do we know what real profitable investments would be relative to the cost of borrowing as a reflection of the savings in the economy to sustain such investments, to make them possible over periods of investment times? We don't know. And we have not known for 10 years because interest rates have not been telling the truth. Think of what the Federal Reserve does as manipulating interest rates as a price control, right? Think of like rent controls, right? The government sets the legalized rental fee for housing, let's say, below the market rate. So you create this imbalance of too much demand relative to too little supply. Well, you just have a shortage then. But that's what the Federal Reserve does with interest rates. But rather than this bleakness of a shortage becoming clear, the Fed just prints money to make up the difference of a demand to borrow at those unnatural low rate of interest relative to the actual amount of savings in the economy to sustain investments. So it's inevitable that this is going to set off those investment instabilities and mismatchings that are going to result in a recession at some point in the future, regardless of anything else. But the fact is that this is a disaster. It's inevitable that you would have some type of severe downturn because we have no idea what people have been investing in terms of reasonable and rational profitability, given the scarcity of real resources to support it.
Well, and it seems to me that leads into this whole boom bust cycle that comes with monetary central planning, that they set the stage for the new boom by inflating this bubble. They won't let firms go under. They won't let banks go under. I mean, when was the last time you saw a bank go under? I don't know if I ever have. They simply merge them with healthy banks. And so they prop up this system. And then the inevitable panic starts where you see prices start rising and they start to contract the money supply with this, or at least contract the increase in the money supply. And then comes the bust. And instead of letting everything shake out, they freak out and panic. I remember Bernanke saying that the 2008 crisis came close to a worldwide depression that was going to be worse than the Great Depression. Well, that tells you that things are pretty precarious, it seems like to me, because at some point in time, this thing cannot last forever, this cycle of booms and busts, and they're going to get to a point where something cracks. And there, I mean, suppose, Richard, for example, you take the FDIC. It's supposedly insures everybody's money in there to the tune of, I don't know, 250,000 or something. Well, it used to be 100,000. And why do they keep raising it? It seems to me that they want to assure depositors everything's okay. Well, okay, everything is okay if it's 2 or 3 banks that fail. They've got enough money for that. But suppose there's an industry-wide banking collapse. Then what? They don't have the money to cover everybody's deposits. And I just keep wondering, given the fact that they've propped up this system over and over and over again since 1913, how precarious is it really? And could it come to a point where there's just a huge mega crash that wipes out the banking industry and wipes out everybody's deposits? I mean, I can't tell you that's going to happen tomorrow or not, but it seems to me that when you have this kind of systems of booms and busts and booms and busts and bailing out banks and bailing out financial firms, that you're setting the basis for a very precarious situation.
Yeah. My only hesitation is that it's very easy to cry wolf. And people have cried wolf about the financial system many times in the face of Federal Reserve policies, and we've not had such a disaster like you're alluding to. But in principle, the instabilities, the imbalances, the maladjustments, the malinvestments, uh, the perverse expectations that Federal Reserve policies time after time generate uh, can easily, at some point, in principle, lead to an uncontrollable downturn that brings the entire financial system and everything related to it, which basically means almost everything, into a severe and falling crash. But when that might happen, how it might happen, what would trigger it, what the consequences of it been, nobody has those tea leaves to read. But what can be said very clearly, I think, is that to prevent that inevitability or anything even bad less than a catastrophe, uh, steps towards reform of the system have to be introduced. And by reforms, I don't mean what the mainstream monetary and macro and central banking economists mean by it. Oh, we're going to tinker, we're going to, change this rule, introduce that policy. We need to have a serious reform of the entire monetary and financial and banking system, by which I mean realizing that the central core problem is not what the Federal Reserve does or what policy tool it has available to implement. It's the institutional structure itself. That you basically have to begin a course of basically the abolition of the Federal Reserve. That is the privatization, the denationalization of the monetary and banking system in the United States. That itself will shake a lot of things off the branches that have become dependent on this type of security. You were mentioning the financial sector in the 08, 09, 2010 situation. I was doing rather detailed following of a lot of those things. And what was most interesting, Jacob, is that in 08, 09, if you followed what was happening to unemployment as the economy is going through this downturn cycle, unemployment in the housing sector, in the construction sector, in the restaurant, entertainment sectors, because people are losing their jobs, they're concerned about the future, they shop less, they go out less to eat, they go to a movie. The housing market is obviously imploding. When you broke down the employment and unemployment numbers, by sectors of the economy, there were two that stood out. Not for the severity of rising unemployment, but the opposite. The federal government sector. Employment increased, it did not decrease. The recession was good for government job opportunity. And the other one was the financial and banking sector. There was virtually no increase in unemployment in the financial and banking sector because of all of the Federal Reserve propping up policies, whether it be a senior executive or the teller at the window at the local branch. Virtually no one in the financial sector lost their job. And that's because the government was doing everything possible to see and assure that these banks, they were just too big to fail. And if I can just make one other point about this, Jacob, in this context. I think it was October of 08 when this whole thing was threatening the financial markets. Paulson, who was then Secretary of the Treasury, and Bernanke called most of the leading bank executives to a meeting in Washington, D.C. at the Treasury building. And they showed up. And Bernanke and Paulson tell all these banking executives, the financial situation is in bad shape. We can't afford a meltdown. So we've decided, that is the U.S. government has decided to infuse capital into all of your institutions, to shore up your capital, financial capital base. And you're going to sign over shares of your banks to the federal government. In other words, the U.S. government is going to partly nationalize your financial institutions to give you all of this financial capital to see that your institution won't get wobbly. Well, there were a couple of banks who basically the representatives got up and said, yes, it's a bad storm out there, but we think we can weather the storm without financial support or intervention of capital infusions by the federal government. Paulson and Bernanke basically told all of those executives, no, because if you don't take it and other banks do, then it will look like they're so bad off, it will cause a panic with them. So all of you have to accept this infusion of federal money, regardless of whether you think you can weather the storm or your individual financial situation. And none of you are leaving this building today until you've signed the document signing over shares to the federal government in exchange for this compulsory infusion of capital. At the time, I wrote a short article based upon the news reports of this, and I called it a shotgun wedding towards monetary socialism. Because even the banks that didn't want it were told, no, you ain't leaving this building until you turn over part ownership to the federal government in exchange for capital infusions.
Yeah, that's a fascinating story, very revealing. And, you know, Richard, if you look at where we are, I mean, you've got now $31 trillion in federal debt. You've got the government spending far more than what it brings in with taxes. There is no attempt at all to live within its means. Each time the debt ceiling is reached, and the debt ceiling, it seems to me, is an acknowledgement by Congress that too much debt is a bad thing. So every time the ceiling is reached, you have all the Chicken Little saying the sky's going to fall, and that has to be extended, lifted. And then as soon as it's lifted up to a new ceiling, everybody forgets about it. And nobody says, hey, we need to slash spending now to make sure that we fall within the new ceiling. Everything just returns back to normal with out of control federal spending. In the meantime, you've got the Fed over here raising interest rates. And it's not surprising at all that President Biden, in the Inflation Reduction Act, which was really funny, he secures authorization, the financial authorization, to hire 87,000 IRS agents, many of whom are going to be armed, because he wants to squeeze the American taxpayers out of more money from taxes. But at the same time, Richard, I don't see how they're going to handle this debt without the Fed printing the money to pay off the debt. I just don't see how this thing's going to end well. It seems to me like a lot of forces are coming together in a perfect storm here.
Yeah, the Congressional Budget Office does both short-term and longer-term forecast projections of the budgetary and financial situation of the government. And in their last semi-annual summing up of how things looking to the 10-year future, they point out that the government will continue to run trillion-dollar deficits annually, as far as the eye can see. And they point out that 10 years from now, in 2032, they're projecting, given current entitlement programs, discretionary spending, current tax laws of the government directly pulling in revenues, that 10 years from now, in the year 2032, the budget deficit for that year will be about $2 trillion. And out of that $2 trillion of borrowed money, half of it, that is $1 trillion, will just be to pay the interest on the then accumulated national debt.
Okay, well, on that bright note, let's wrap it up. Keep in mind that this is why we have our online conference going on right now, every Monday evening at 7 p.m. We've got speakers, outstanding speakers and presenters, including Richard, who gave the initial presentation 2 weeks ago. Next week, we have Kevin Dowd, who I know y'all will enjoy, on this important subject of end inflation and the Fed. So we hope you tune in next Monday at 7 p.m. Eastern Time. Richard, on that note, we got to wrap things up. Greatly enjoyed the conversation. Thanks for your excellent insights on Bernanke's winning of the Nobel Prize. And thank you all for tuning in and for your support of FFF. And we look forward to seeing you next week. Richard, see you next week.
Till next time.